further ado, here's my bestie, Tony Hoon. Take it over, dude.
All right. Thank you. Thank you, Annie. Yeah. So good evening, everyone. Thanks for joining us here tonight, talking about taxes. I'm there. Again, Jonathan's got the camera on. Nice to see your lovely face there. Looks like you got a lot of books, dude. So you study well, I bet. Nice. Well, that's cool though. But so yeah, tonight, so yeah, quick background on myself. I'm a CPA, own a tax firm called the CPA Dude, and essentially we just help people save money on taxes and not overpay the government nor tip them. So that comes with tax strategy, planning, filing, accounting, the whole 9 yards, whatever you need. We try to find some solutions and solve problems for you at the end of the day. So yeah, one big secret tonight is just, taxes, right? You can defer taxes. That's the key part of building wealth. And how you defer taxes is how much more wealthier you can get. So the big part here is like, what tax strategies can you use as real estate investors? And tax code, it's written, I always say it's three ways it's written for. It's real estate, charity, or business, and you need to plan one in three. I just made like a little like meme thing. It was like, it was like Bulbasaur, Charmander, Squirtle, and I was like, all right, these are like pick one or pick two or three, and this is how you're gonna save money on taxes. So on that portion, like real estate's one of the best vehicles on this side. And for 1031 exchanges, as Annie kind of alluded, what is 1031 exchange? Why is it good? Why is it bad? But just a quick background for folks who don't know what the 1031 exchange is. It's literally section 1031 of the tax code. And it just simply says that you can trade up your property and not have to pay any taxes on it, and you defer taxes until later. So it's this one code section of the IRS, super powerful. And this is literally how generational wealth is built, actually. So there's the buy, borrow, die strategy. And literally, like what that means is you can buy a house, you can borrow money against it, and once you die, you pass the cap, you pass it off to your heirs, and all your taxes are wiped. So on a 1031 exchange, what that simply is that if you have one house and you trade up for another, all those taxes are deferred. You can do it again, and all those taxes are deferred. So literally, if you just keep on trading the same house forever, you never have to pay taxes on it. And once you pass, your heirs, your kids, they don't have to pay any taxes on it. So this is literally like buy, borrow, die. Robert Kiyosaki, what he's doing. And the 1031 exchange, as Annie said earlier, there's a few rules you have to do. And, she's done one herself and gonna do another one. And, it's 45 days. You have to identify the product, like the property, and it has to be like kind, right? So you have 45 days to identify what you're gonna buy. So once you sell it, and you're like, damn, you better start searching ASAP, or you should start searching ASAP before you even sell the property. Really, if you want to plan ahead. And then you get 180 days to close on the property. And like these dates, there's no joke behind them, no extensions whatsoever. Like if you miss it by one day, you're done. You won't qualify for it. You'll be automatically disqualified. So there's no extensions. The only one that happened was actually a couple years ago. It was, I think it was the California floods we had in the Bay or across the whole state. That was when it got delayed, but that's because it was a natural disaster actually. So generally speaking, you won't get Mother Nature to bail you out. So the 1031 exchange just has a lot of strict time periods, and may not be realistic for you to execute within that 45 and 180-day time frame. And this is where the great stuff is for lazy people. It's not lazy, right? So it's just really clever and really smart. And that's what the lazy 1031 exchange is. So lazy 1031 exchange is actually not real. It's like completely fake. It's just it's a marketing term,
Hmm.
more or less. So you can't actually go to the tax code and be like, hey, what code section is this from? It's actually a mix of code sections. So it's actually not related to code section 1031. It's actually related to code section 168. And how does the 1031 exchange, like lazy 1031 exchange work? At a very high level, to keep it simple, is that you sell a property, you pray you have cap gains because you don't want cap losses because that means you lost money on the property. And so you have capital gain. You're like, oh, okay, I've sold this house $100,000 as capital gain. And then you're like, well, shoot, that's a lot of taxes. On the federal side, you can go all the way up to 23.8. If it's a California property, you can go all the way to 13.3. So we're talking about 36, what's that, 23, 37.1% of your profits just gone. And I'm like, last time I checked, don't think anyone likes to pay taxes. So it's like, all right, what can I do? Right. And there's many options you can actually do to mitigate capital gains taxes. But the lazy 1031 exchange is great. And it's actually going to be even better with the new tax law changes. So step one, sell the house, right? Sell this investment property, generate capital gains. Step two is just literally start searching for another house before year end, though. You have to buy the property and place it in service before year end in order for this to happen. And then last part is number three, and it's actually going to ties in the whole tax education part, is that you do have to run a cost segregation study on the property that you buy. And when you run a cost segregation study, that's going to just light the depreciation on fire. And then you're going to have a big bank of depreciation to offset those capital gains. So for those of you guys who don't know what a cost segregation is and what bonus depreciation is, what it is that on a whole house, residential real estate, the whole house is considered 27.5 year useful life. So the IRS thinks that your doors, your floors, your cabinets are going to last 27.5 years. But anyone who has tenants, we know those things don't last 27.5 years. They last a lot less of a time frame. And what you can do is order a cost segregation study, which is a third-party study. You're going to have to pay, a couple grand for it. And what's going to do is separate those components from 27.5 years to smaller components. So 5 year, 7 year, 15 year useful life. And now, why do you do that? Is because now you can use a tax strategy called bonus depreciation and take all of that, or 40% as of today. It might change in a couple of days, which I'll talk to in just a moment, is that you can take a bulk of that in the first year because bonus depreciation only affects property that has 20-year or less useful life. So before you have the whole house at 27.5 years, you can't bonus depreciate squat. With a cost segregation study, you've segregated the components of the house in a smaller bucket so you can now light it on fire. So current year, 40%. But, surprise, cat's out of the bag. I also posted about it yesterday, was 100% bonus depreciation, like 99 times out of 100, it will pass. They're trying to get this done by July 4th. So we got like 2 days to figure this out. It passed the Senate yesterday. So what happened was House sent their version to Senate. Their version said 100% bonus depreciation, but it's going to phase down after 4 years. Then Senate kicked it back and said it's 100% bonus depreciation forever. So that shit's like crazy. I was like a kid on I don't know, I was a kid at candy store yesterday when I read it. So now back at the House, they're going to approve of it more likely than not. And then it's going to get signed by the president. So 100% bonus depreciation makes this lazy 1031 exchange super powerful. Why? It's because it's actually useful now. So let's just say you sold, any solar property has $100,000 of capital gains. And now I'm like, well, shoot, what should I do? All right. She's like, all right, I've listened to Tony. He said,
Yeah.
let's 1031
The
exchange.
only other thing,
And then, and then she's just like, hey, I'm just going to get into, say, a syndication. That syndication is going to run a cost segregation, run bonus depreciation, and say it generated $100,000 of extra bonus depreciation. But with the current tax law, that would only be $40,000 in the first year. So once this new law changes, she would get that full 100, and then she could potentially wipe away her entire capital gain. So now that's like huge because now she didn't have to be forced into the 45 and 180-day period. And she can just take her sweet time until the year end and shop around, see what works the best for her. And then this is just big. If I just take a number example, like on $100,000 in California, you're going to pay $37,000 in taxes. So literally, you're losing $37,000 of buying power. Most times you can leverage anything 5x, right? So that's you need 20% down. So on 37K, mental math, 37 times 5, put it on the calculator. That's 185 grand of more buying power. 185 grand of more buying power is like a house in the Midwest. Like you literally can go buy a house in the Midwest. And then say on 185 grand, say if I just say 80% that's building value, times bonus depreciation, that's another $30,000 of extra depreciation you can take in the first year. So this is literally snowballs, and why the rich get richer each and every single time they do a 1031 exchange, a lazy 1031 exchange. So, and then the cool thing about the lazy 1031 exchange is that it works for syndications, which could be really good. But buyer beware, like I don't know who's operating the syndication. So, pick your own investment decisions at your own will. I'm just saying the tax benefits are great for you. You can do single family, you can do multifamily, you can do commercial. So there are rules in the 1031 exchange world that say it has to be like kind property. So if you're selling a house fully owned by you and you want to go get into a syndication, you can't do that because the taxpayer has to be the same in both transactions. So this is actually really big and it's just so much more flexible. So it's like lazy way of doing things, but it's actually very effective. As in the previous like last year or two, we haven't recommended it as much to do a lazy 1031 exchange just because bonus depreciation was phasing down. Like it'd be a terrible strategy even next year. It'd be more of like a plan C strategy. Like I don't want to pay taxes and I'm just gonna use the lazy 1031 exchange as a way. But now if it comes back to 100% bonus depreciation and like all signs lead to yes, it'd be retroactive to January 19th, 2025. So it's going to be real soon of when it would take effect. So the lazy 1031 exchange, the other parts too is you don't need to have a qualified intermediary. So before on a normal 1031 exchange, you would have to have a QI, which is a 1031 exchange company, a resident SARE member, waiving paying with his own company, Excel 1031 exchange. So if you need someone, I was actually on the call with him today and Barb's actually. This is like literally the same network. The three of us were on a call for one of Barb's clients. And then we're just talking about, hey, what can you do to do a 1031 exchange? And there's creative ways behind it. But the big thing on 1031 exchanges is that it just allows you to defer the full thing versus the only downside. So that's all the pros that I've talked about. Now, what are the bad things about it? There's nothing that's ever amazing with no setbacks. So the potential setbacks, so the pros, cons, every tax strategy always has a pro and con. The con here is that if you don't find like not replace, but you don't find a new deal to invest into by year end, you're going to have a fat capital gain tax bill, right? Number two is if you don't buy enough and you're going to have a big capital gain tax bill. So if you don't buy a property that produces enough bonus depreciation for you to offset your capital gain, you're still paying capital gains. Unlike a 1031 exchange, where you defer the whole thing as long as you reinvest the whole thing, right? So you have those two downfalls of not having enough. And then what's the third one? I just like lost this, like slipped my head. So you have that last 1031. I can't remember the third one. It might pop up in my head. What else? Yeah. So the lazy 1031, those are like the downfalls of it. I would say it's just like not horrendous of a tax strategy. It's pretty decent. It's just you can't fully defer the whole thing. Oh, the third one was just like if bonus depreciation doesn't come back to 100%, which I mean it will. I'd be shocked at this point if it does not come back to 100%. So that's kind of like the lazy 1031 exchange in essence in its character. And you can ask yourself, like, a big thing about tax planning and tax strategy is this for you to understand and be aware of these things. You actually don't need to know the ins and outs. That's usually when, contact a tax expert, maybe ChatGPT, right? Like just do like contact someone. But when you do sell a property, this is when you raise your hand. I'm like, hey, I might sell my property. How can I mitigate the capital gains taxes? And then like, hopefully you remember from tonight's talk is like, hey, we talked about that thing called a lazy 1031. How does it actually work? And it just gives you a lot more time. So you have 6 months left in the year. So I guess technically 180 days, it was about the same, just the identification side. And then the other part on the lazy 1031 exchange is that it does save you the fees in the middle. So you may save $1,000 or $2 on doing a 1031 exchange, which is still very small in the overall tax bill of like paying the capital gains taxes. So besides that, that's like the lazy 1031 exchange in a nutshell. It's really simple at heart. Buy property, run a cost seg, bonus depreciate the crap out of it. Oh, the other thing I forgot, the downfall of like lazy 1031 exchange is if you buy a property that has extremely high land value, this strategy is horrendous because bonus depreciation and depreciation in general don't apply to land. So let's just say you buy $1 million piece of property in Hawaii and the beach is 80% of it's considered land value, right? So then $200,000 is only your building basis. And you can only depreciate $200,000 on bonus depreciation, which was probably 40 grand on $1 million home, which is horrendous. Because, if you're just in a normal area, just say 80/20, $1 million home, $800,000 would be your building basis. Probably get easy $160,000, $200,000 as depreciation. So that's a 4 to 5x difference. And that's where you really want to be mindful of when doing the lazy 1031 exchange. There's a lot of like pre-planning work you want to have before you execute it versus if you just do a 1031, even if you buy, a big acreage, right? But there's some decent building in it, you still would be able to defer all the taxes. And then ultimately when you pass, and it goes to, your kids or whatnot, or to your family, whoever you want to give your property to, they'll get the step up in basis, and the step up in basis will eliminate all the taxes anyways. So just a couple of moving parts of like the pros and the cons of the lazy 1031 exchange. Let's see, Andy, I think you typed in some questions. Buy, choose 3 properties, must buy. There you go, nice. It's almost like Pokemon again. But yeah, the on the 1031 exchange, you do have to identify which properties you're going to buy, and it has to be within that 45-day window. If you want to add more properties, it's actually going to cost you a little bit more money. So just be mindful of like the 1031s. There's pros and cons to it all, and that's the same thing with tax planning. These are just all tools in the toolbox, and we just pull them out for our clients when we need to. Like they're always there. It's just you don't pull out a hammer to screw in a screw, right? Like or a screwdriver to pound in a nail. It's just pick the right tool at the right time. And then you have, let's see, how much of this can cover the capital gains though? Won't we need multiple properties with cost seg studies to cover this fully? So yeah, depending on the lazy 1031 exchange, that's really where the numbers bake in and boil in. So the perfect easy world 1031 exchange, you defer everything. You'll need to buy one property with equal or more value of what you sold it for. In the lazy 1031 exchange world, you need to buy enough property that's going to be able to offset your capital gain. So if I say you have a $100,000 capital gain, you probably need to buy probably $800,000 worth of property, assuming an 80% value. So if I take $800,000, multiply that by 80% for building value times 0.2, it's 128,000. So you're at probably about $700,000 worth of property that you need to buy to eliminate that $100,000 of capital gains. So from a 1-to-1 side, yeah, it has to it's technically like a 1 to your effective rate side. So the cap gains is one part, enough properties are way higher. So just because in our example, to offset $100,000 of a cap gain, you have to find roughly about $800,000, right? Maybe $700,000, depending on how much building value of a property to buy. But the key part to remember here is it's better to do a lazy 1031 or a 1031. It's better to do some tax planning versus none. Like I always tell people this, like, dude, do something. I don't care. Like versus just sitting on the sidelines. There's so many ways to offset capital gains. This is just one really good strategy. So it's like 1031, couldn't do 1031. All right, let's do a lazy 1031. Can't do a lazy 1031. All right, let's talk about other things. Like, were you like a really bad stock trader? Like my dad, actually. Dude lost over seven figures in the stock market. Horrendous. Otherwise, I'd be a trust fund baby by now. But over here doing taxes with Andy. So it's all good. So on that side, like you could unlock all those capital losses you've had before to offset this capital gain. So if you're a horrendous stock trader or lost a shitload in crypto, this could actually be an alternative for you. So that's just called tax loss harvesting, is what the fancy term is. But it's just like, dude, you had losses, realize them and offset it. So if you have really shitty positions in your stock portfolio, hence why you're getting into real estate, just liquidate that, offset the cap gain. So that's just another tool in the toolbox to offset capital gains, because that's like the main theme of the topic. And yeah, because I think the reason why I just like hark on is like on $100,000 capital gain in California, it's assuming you're at the highest rate, That's $37,000 that you're paying to the government. And then if you take $37,000 and you compound that by 8% for the next 30 years, I would probably assume it's probably close to $1 million. The one example that I do know off the top of my head is that if you save $10,000 in taxes every single year, and compound that at 8%, that's $1.3 million in 30 years. 300,000 of that's your principal, $1 million of tax-free growth. So that's just like the power of compound interest, along with not paying taxes, is because you just keep that wealth. Like if you got $37,000 tomorrow, like what would you do with that? Like take a vacation, buy some more property, buy Labubu, I don't know, like whatever you want. Like just do your thing. But I'm sure everyone on this call would say I would take $37,000 versus giving it to the government. That's why I'm like, do something. Just don't do nothing and sit on sidelines and just be like, all right, next April, here you go, take my money, Uncle Sam. Like, it's just not a really great tax strategy. And then there's one last one that we've recently been using in the past year for our clients, just because bonus depreciation was really phased down and it's not as good, but it's called the long short strategy. Essentially, these portfolio managers are able to take your stock portfolio, they'll leverage against it, create a crap load of capital losses for you, and then you can offset your capital gains that way. So another creative way, if you have a heavy stock concentration, to reduce the amount of capital gains you have to pay. So it's not like at the end of the day, like some is better than none. That's what I want to just leave everyone here with is like, hey, have some tax plan in place. If you're going to sell something, if you know you're going to sell something, go talk to your advisor, just have the conversation. If you sell the property, there's usually like not a ton you can do in advance, but the lazy 1031 exchange is a good band-aid solution. Like say if you did all this and you're like, oh shit, got a lot of cap gains, do the lazy 1031, but do it before the end of the year. Don't think that you can go file your taxes next April and think you can save yourself from this. Like that property has to be bought in 2025, placed in service in 2025, just so if you're going to buy like a fixer upper, you better fix it and place it in service by year end so you can have bonus depreciation on it. So it's just a pretty good strategy. I do like it overall now that bonus depreciation is back to 100%. But your traditional ways of doing a 1031 could be a little bit better if you're like up for the stress of the timelines. And just the pros on the normal 1031 is that it can just be deferred like fully if you buy enough property and you add enough debt. And then you really don't have to think about, hey, how much is the purchase price? How much is the building value versus land value? And then you don't necessarily have to do a cost seg on the 1031 exchange versus a lazy 1031, you have to do it a cost segregation. So pros and cons on it, but yeah, overall, that's the nuts and bolts of a lazy 1031 exchange. Hopefully, it didn't confuse people too much on that side. If I did, feel free to ask some questions. It's not the sexiest thing in the world, but let's see here, Rebecca, how are you doing? Let's see, can you use gains from interest income and stock dividends and offset that with passive losses from rentals? Is dividend income considered not counted as passive, like long-term rentals, sell stocks for tax loss harvesting? Seems then buy them back later. So for interest and dividends, it's actually considered ordinary income unless it's a qualified dividend. So ordinary income, they don't allow you to offset with capital losses. Capital losses are just reserved for passive losses. So, or like in that nature. So it's like, I would say it's like oil and water. Ordinary is down here, passive real estate's down here. The two just don't mix. So you wouldn't be able to offset interest and dividend income. However, let's see, the part you could sell stocks and buy them back later. The biggest thing is just to watch out for wash sale rules. So wash sale rules simply state that if I sell Apple today for a gain or a loss today, and then I buy it back in less than 30 days, that loss will not count. So this is actually how a ton of like the stock dudes that we work with, they get burned on this. They're like, man, I lost like $1 million trading. Or no, like what's it? No, they say like they broke even on $1 million of trading, but then they have $1 million of like what do they call it, unallowed losses because they're all wash sales. And then they have to pay gains on that. So they're like, what? I owe taxes? I'm like, yeah, dude, it's not pretty. So that's why you want to be really mindful when you're trading that 30-day period. That's actually how the long short strategy that I talked about earlier, how these like crazy wealth advisors do it. What they actually do, I was trying to really understand the strategy. I'm like, wait, how are you creating capital losses out of thin air? And what they do is that they buy Pepsi stock today. If it sinks and dies, like drops a little bit, then they sell it, realize the capital loss, then they go buy Coca-Cola stock, which is pretty much the same, more or less like stock. So their portfolio is still balanced with the same stocks, but they able to realize the capital loss. And the reason why they can realize these capital losses and not care is because you have your main portfolio, they're pulling margin on it to trade in a portfolio just to create capital losses. So it's a pretty elaborate strategy, and you do have to plan pretty far ahead. Like our business owners that are selling their businesses, this is really where we're generating a ton of capital losses for them right now. So it's just another alternative strategy, especially if you have stock sitting around. Like if you have a stock account and it's like not doing much, you might as well just like let this dude manage it. Fees are kind of high. I was like, it's like 2% AUM. And I was like, Jesus. But the capital losses, even if they suck at their job, the capital loss, if it's high enough, it's going to save you so much money. Like, all right, your 2% washes away completely. So you kind of, it's one of those premium services that you pay for. A lot of the like NVIDIA clients that we have, they're also using the strategy because they need to create capital losses out of nowhere to get rid of their stocks and diversify. All right, Dan, let's see here. Is there a threshold below which a cost seg study may not make sense? 1 million value of structure, 500, 200. So the joke answer in taxes is it depends. And it's really what's material to you and what's worth it. So like, we've all been, oh, I don't know how many of us are in San Francisco, but like we've always seen like in NSF, right? You got like the old like Chinese pole collecting like 5 cent like water bottles, right? Like 5 cents to her is worth it. Like, Annie, big baller Annie over here, she's like, she has thousands of these. She's like, no, I'm not picking up shit, right? She doesn't care. So it depends on how material it is to you. And like, let's just break it down for you here, Dan, to give you like real life examples. So I'm going to pretend that between federal and state, you're in a 30% effective tax rate, is where most people land, anyways, between both fed and state. And say on a 1 million value structure, I'm going to use 20% as the multiple. And that 20% multiple, where I get that from is I see cost segregations that range from 10 to 30%. So I'm using 20% as an average of how much bonus depreciation you can get in the first year. And I'm assuming you're going to take 100% bonus depreciation what the tax laws are going to pass this week. So on a million, that's $200,000 of bonus depreciation multiplied by 30% for your effective tax rate. It's going to save you 2 times 3 here, 60 grand, right? And then you got to pay, let's just say $3,000 for the study. You're up 57, right? Now, 500, just divide that by 2. So you're at 28.5K of net savings. So like 28.5K is still material. Now we're down to 200. So 200 times 20%, that's 40 grand. 40 grand times 30% is 12,000. 12,000 minus your cost seg fee, you're down to 9,000. So is $9,000 worth it to you for the headaches? To me, it is. I'll take 9 grand, right? So, but if you're a big baller, Annie, and you're like, 9K, yeah, okay, it's all good, right? So it's really up to you on is all that headache and squeeze worth it or not. I think I'm just too Asian not to care about it. I mean, I treat every one of our clients' dollars like it's my own. Like, all right, this extra dollar, I'm taking it. Let's anything we can save, right? But that won't cut corners, of course. So that's a thing for you there, Dan. So yeah, cool. All right. And then Jonathan, all right. 1031 exchange, lazy, 1031.
Well, actually, going back to his question though, like if some of the properties are too cheap for 200,000, or like their property doesn't cash flow, there really isn't much of a need to do it either.
If it doesn't cash flow, definitely not needed. If it does cash flow, yes. If you're reps, yes. STR loophole, deaths, but like 8 times out of 10, no, on a 200K property.
Mhm.
So you just got to really run the numbers. And I think I've told the story like multiple times, but it's just like, it's just a reminder that you do get what you pay for, generally speaking, in life. And it was a cost seg that was like 700, $800. I can't remember the numbers anymore. $700, computer generated. Then we had, it was Boomer study actually, Annie. Boomer
Mm.
came in.
Oh, he does a computer one?
No, no, no. He does a real life one.
Right,
Yeah.
right, real one.
Yeah. So we took a computer one, $800. We took his with 3,000. It was bank, right? So you're like Asian, like, ah, hell no, I'm not paying 3K. Right? We got this one for $800. But then we compared both studies and how much depreciation you get. Like boomers came out well, like even the incremental $2,200, it was still like $6,000 positive overall because he found so much more depreciation. So not all cost seg reports are the same, and you do get what you pay for. So just because you hear one price, it doesn't mean all that. That one saying, what's that one saying? The price is what you pay, value is what you get. So it's kind of like the same as like if I compare CPAs, like yeah, there's like China. There was funny. I was actually talking to this OG 80-year-old. His name was Mr. Wu, and he was referred from Realtor to me. His homie's trying to sell us like $3 million home, and then he's like, "How much do you charge for taxes?" I'm like, "Yeah, we start at 1,500." He's like, 1,500 any cheaper? I go to Chinatown for 100, and I'm like, "Bro, I can't even cover my labor for $100 for my team." But at the same time, I'm like curious, like, yo, what does his taxes look like? It could be really bad. Like the other day, I was reviewing new clients' taxes. They literally missed out $7,000 of was it capital losses for them. And I'm like, bro, why does this not on the return? I'm like, here you go, man. I just paid for myself, right? So you do kind of get what you pay for in the world, but yeah, $200,000. Yeah, it depends on if it's worth it or not to you.
Right. And then plus with this cost seg, it's like it's not just for one house. Like if you have multiple houses, you can kind of strategize. I'm like imagining, say, hey, I do have pretend I have like a $1 million home in San Francisco that really doesn't cash flow very well, but the property is worth a ton. I can do a cost seg, but say I own another 6 or 7 really cash flowing properties from out of state. It's still beneficial to do that in that case then.
Yeah, 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 exactly. Like those, that one big property could offset all the other properties because how the taxes work is that you add up every single property and then you sum up at the end.
Mhm.
And then you take that against your returns. So yeah, you got highly profitable ones, you got one sinking money, and then they all work together.
And then is there a maximum that can be taken? Like for example, pretend I banked 300,000 in my bonus depreciation because say I have like 5 or 6 properties, and then the next property that I'm going to sell, I'm going to expect say 300,000 of capital gains. Will that really hit a dollar for dollar, or is there like a maximum that I can cover?
Oh, you can cover you can go full on the cap gain. Anything based off that will just be rolled forward as an operating loss, passive loss moving forward.
Do I
So
need to
even
be
if you
like
have
an
more
RAP?
DQ, oh, what's that?
Do I need to be like an RAP to get 100% like that covered, or no?
No, if you want to be, it'll just go into your passive piggy bank. So if you're REP though, you can go to your active. So you get it regardless though. Yeah. So you still win. Yeah. Andy one day is gonna marry REP. That's the real secret here.
I
So
would, but I'm not high enough W-2 earner enough. It's not worth it. Maybe I'll just be the RAP.
there you go. There
Oh
you
wait,
go.
didn't you say California doesn't recognize RAP or something?
That's the recognized bonus depreciation. Yeah, so
Ah, darn
the
it.
state doesn't conform to that. So what simply means that if you have 5-year property, like this happened on my car, like I can write off my full car on federal because it's over 6,000 pounds, but on state I had to deduct it over 5 years.
Boo. Move to Texas.
Yeah, no income tax, just very hot, very hot. So great. And then Jonathan, what do you got? You got a good recap here. 1031 exchange versus lazy 1031. 1031 exchange requires a property to be an investment or a rental property. Lazy 1031 exchange, that is also true. Correct. Yeah, because bonus depreciation would
Okay.
only apply on investment properties. So this
Yeah.
is, or it can be commercial properties that use for business.
Mhm.
That works too. So say if you have like a restaurant or something, you could, yeah, you wanted to buy the building, that would qualify too.
I see.
Yeah. And then creative ways to work with real estate. Your family owns one property, and then we second mortgage, sells property, and do a lazy 1031. I guess it really depends on what you want to do with it. Do you want to get rid of it or no? I would like
Uh,
keep it forever.
I
Yeah.
mean, I follow. Do you follow Grant Cardone? Like he says that um, one of the strategies is that you purchase like a multifamily, like a quadplex or a triplex or something, and then in the property that you live in is you live in a rental, so that instead of purchasing a home, you live in your own live-in rental and pay monthly because it's cheaper to live that way, apparently. I don't know.
I mean, if you're in a high cost of living, like if I'm in San Francisco, for
Yeah.
example, and if I
Mhm.
can rent cheaper than I own, yeah, that would make
Yeah.
sense.
Yeah.
But
Yeah.
then if you're in areas where you can afford where you're living and you have good appreciation, or if you house hack, it,
House hack. We live in a house hack right now.
yeah.
There's an ADU in the back, and yeah.
Yeah, I mean, in that situation, like for you can get a lower down payment too, sometimes like 5%. So like if you're able to do that, plus you can house hack and make it worth it, it makes
Hmm.
more sense to own than to rent, because then
Right.
you
Yeah.
can let it appreciate. Like you're only putting 5% down, but like the appreciation still go up, and I
Yeah.
can still pull money out and then buy another property. But you can't do that if it's a rental income, and
I
you're
see.
gonna
I see.
miss out on, the every 5 years you can have like
Equity, right? Equity.
capital gains if you
Home
sell.
equity.
Yeah, so you miss out on all of that.
Yeah, that's right. That's right.
I wouldn't necessarily say
Rookie question.
it's better to live in a rental than a buy, unless you're like in a very high cost of living place.
Yeah. Okay.
Yeah. Always depends on the numbers. Where do you live yourself, man?
South Bay, between San Jose and Fremont, Milpitas.
Okay, in that case, please rent.
Yeah.
Please rent. I had the exact same conversation with our friend Jenny, because she wanted to buy something in like a Mountain View close or that area, or just be closer to her kid. And it's like it's gonna be $15,000 a month for a mortgage, whereas the place that she's gotten is really nice. It's like 4,500. And I'm
Mhm.
like, dude, just take that 10, 11, 12,000 difference, go buy like several other properties for their mortgages. Like, and then
Yeah.
just take the money from there for rentals and appreciation and then cover your rent.
Mm-hmm.
Again, it really depends on where you live.
Okay.
Yeah, yeah.
Thank you for
I think
clarifying.
all the advice is always depends on like your situation, of course. But
Yeah.
yeah, Annie will give you the answer here. Yeah, yeah. It is daunting. Like,
Hmm.
yeah, if you have to, I mean, you have a $10,000 difference, and you know how to use money to make money.
Hmm.
It's a world of difference. If you give me 10K, I'm going to turn that into 7.
Yeah.
So it's like,
Yeah.
no, I'm not going to pay it
I
myself.
had those savings before, and then it went straight to my college fund because I didn't know about how to use money to make money before.
Oh, yeah,
I
yeah.
had like that amount to work with, and I was like, instead of making it work for me, I was like, oh, I guess I'll invest in my understanding of, engineering and school and all that. So
Oh, okay. Yeah, no,
yeah,
they,
at the time I was like 18 years old. I didn't know what to do. I had not heard about like real estate before, uh,
uh,
in the way that we talk about like how to make investments and all that. So yeah,
yeah, the phrase is always OPM,
yeah,
other,
other
other
people's money.
people's
Yeah,
money, man. It's
yeah, exactly.
it's all about using leverage at the end of the day. I was
Yeah.
actually with our that's all the Sarah homies, really, Annie. I was with Rick. We're in his Rolls Royce doing a podcast. I was like,
Yeah,
Jesus, man.
yeah.
And we're talking about how bad Asians are with their mindset with money,
Oh yeah,
how we're scared to use
scarcity mindset, right?
But
scarcity. Debt.
that's if you think about it, in the last just 100 years, us
Yeah,
Asians or Asian Americans, we've gone through so many warfares and famines. It's literally a
Opium War.
survival.
Yeah,
Yeah, and like Vietnam
Vietnam
War,
War,
Korea
Cambodia,
War, like the
Korean War.
Chinese Wars. There's
Yeah,
multiple. Like they can't forget that. And
yeah.
what saves them was
It's
like,
programmed into us in
yeah,
our
it's program
DNA.
with us. Save their golds to trade it
Yeah.
for milk powder. That's what my grandmother had to do for her kids, you know?
Yeah. Even like also like with like Chinese food and when the railroad was being built, like the food was like artificially like kept low. Like prices were artificially kept low because they didn't want, I mean, they wanted the Chinese workers to work on the railroads, but like not to like come in droves and like, occupy the land and all that.
Mhm.
So
Yeah. Yeah. So
yeah,
yeah, leverage cash. That's
yeah,
also how the tax code's written too. So like
yeah.
if you're leveraging, well, that's the one thing. If you leverage a loan, so like say if you have good equity in your home,
Hmm.
leverage a line of credit, it's not taxable income to you. Now you
He
can
lost.
use that line of credit to go buy more property
Yeah.
and save more money on taxes. So the government encourages leverage. So just be
Yeah.
smart with it, of course. Not was that Dave Ramsey? I lost everything.
Yeah.
Yeah. So nice. Cool. And then one more from Rebecca here on the depreciation recapture and don't do a 1031. If I sell my rental that I've been taking 3871 depreciation each year for 27.5 years, I rented out in 2019 and sell in 2026. How do I calculate the recapture amount? So the recapture amount is all the depreciation you've taken is, so if you take a 3871, and I'm assuming you took the full amount in 19 or the pro rata, you would just take 19 to 26. So that's 7 years. 7 times 3871 is your depreciation recapture amount. And then your depreciation recapture tax is equal to your ordinary income tax bracket, or max rate is 25%.
Oh, okay.
Yeah. So that's actually like one thing of how you can actually arbitrage the tax code on depreciation recapture. So people always talk about depreciation recapture. And for anyone who doesn't know what depreciation recapture is, it's just simply paying back all the depreciation you've taken on your rental property in the past. And the cool thing though, it's capped at 25%. So if you're in the 37% tax bracket in the year that you took the benefit, you're actually going to arbitrage 12% of a difference. So depreciation recapture is actually not that bad. I like usually a lot of people are like, oh my God, depreciation recapture. I'm like, nah, chill, dude. It's cool. Like you're totally fine. You're just paying back the benefit that you took already. And then you'll just take the same benefit when you buy a new property, run a cost seg, run bonus depreciation, if it's a short-term rental or if you have reps.
Okay, so it could be less than 25%.
Yeah. So if
Oh,
it,
okay.
say if your, that's the max. Let's just say if your ordinary income tax bracket is 22%, you just pay 22%. Or if it's less, 12, more 12, 10, 12, 22, 24 are your tax brackets.
Okay.
Yeah, up to 25. Yeah. So if you're in the 32, you're winning. If you're 37, you're winning. But yeah, it's just maxed at 25%. But yeah, one thing to consider on when you do sell a property is that you do have to reduce your basis in the property by how much depreciation you have taken because you've taken that benefit.
So with the lazy 1031, so say if the property that I'm currently selling, I've already ran a cost egg on that before and doing the depreciation, meaning I know I'm gonna have to recapture the depreciation. Will but I also have multiple properties that I've also run cost eggs for, so I have a piggy bank of those depreciation. Will that be able to help me cover the recapture, or I still have to pay for the recapture?
Recapture, you always have to pay for. Cap gains, though, you can tap into the piggy bank. Yeah, the one thing on recapture doesn't go away. And I actually did it was an interesting question that I had to run the numbers for. It was a primary residence converted to a 10 like a residential or a residential rental property. And so if you live in the house for 2 of the last 5 years and owned it, there's that 121 exclusion. So you get the first $250,000 tax free. Or if you're married, you get the first $500,000 tax free. So that's like what the 121 exclusion is for owning and living in your own home. But then the scenario was they live there. They're going to move out. This is in San Francisco, actually. They live there. They're going to move out, STR loophole it. Then the year after, they're going to sell it. And then they're curious what happens to depreciation recapture. And depreciation recapture does not get exempted by the 121 exclusion. So you took the benefit, you have to pay it back. The only times you don't pay it back is if you do a 1031 exchange, right? Because you just kicked it down the road and then you just die. Then you pay with your life and your heirs get, the property tax free. That's like the only real way to avoid depreciation recapture. Even the lazy 1031 exchange, it indirectly will reduce depreciation recapture. But once again, if you don't have enough losses, you won't offset it. So 1031 exchange still is a very powerful tool to the day. If you can pull it off, I do recommend it. If you can, it's not the end of the world on that side. And also on 1031s, and say if you're just like really don't want to do a 1031 exchange on a primary residence for yourself, You could do a DST. So you could just trade it into a DST. And then the DST is just like a mini syndication for 1031 exchanges specifically. So that's a deferred sales trust or Delaware statutory trust.
But if I do the DST, wouldn't that count like would I have to identify as one of the three properties?
You would probably want to do 3 properties and also add that as a list of one of your potential parts. Yeah. So if you have a failed 1031 exchange, just go into a DST.
Right. I mean, like, but then I only am allowed to pick 3 properties to choose from. I don't get a fourth.
Oh, you get more. You just got to pay for it.
No, I mean, if you do more for it, what I was told is that you have to buy 90% of it.
By
Yeah,
90%.
so say if I have
Oh,
five
yeah.
properties or something, then I'm gonna pretty much have to buy 90%, which means I have to buy all of them.
Yeah, you have to pick a mix, or one of them has to have enough of that,
Right.
right?
My choices were when they told me was I only could either choose 3 properties.
Yeah.
That does not equal to I think more than 2x the total of the house or something. And then I can do as many as I want, but I have to buy 90% of it. So I could buy 5 or
Oh,
6, but smaller ones, but then that would have to cover it all.
even for the ones that you identified, if you put on your list, you have to buy 4 or like 90% of how many. So you put
Ah.
10 in there, you have to buy 9 of them.
Ah.
Oh, that's terrible.
That's only if you pick the multiple one. That's what I was like thinking how to use it as a backup unless I'm taking away from the 2 spots that I've already chosen properties, just hopefully go through and it fails, then I pick my third as a DST.
Pick your third. Yeah, the DSTs are always backup, but DSTs aren't the best investment
They're
vehicle.
not. They're like usually there's a lot of high costs and admissions fees, and it's really hard to get out of it too to actually get any money out.
Oh, you're stuck. You're
Usually,
married.
most of the people are stuck to the DST. So I actually I don't know if I don't know enough to say like what if I would have recommended it or not.
Yeah, I met this one DST dude from Korea. He was pretty chill, but it's still your backup option. I'd still say do it normal 1031. I'm just saying like if you fail at it, this is your backup option.
Well, this actually sounds more like a better backup option because I'm not listing it as any of my options or anything. I try my best. I can if I can do it, great. If I don't, then at least hey, I still can run all the cost segs. So it's like even if it's at the end of the year, I still have time. It's really I can go all the way until the next tax year, like in April, to get all my cost seg done and then still apply it.
Yeah, exactly. Yeah, there's also the other flavors here that we didn't dive too far into, but like there's a reverse 1031, very expensive,
So it's
but you're probably talking like I think Waymeaning still has the homie rate and it's still like 8K. Like any other firms are gonna charge you 10. So, but
right.
the
That's
reverse
the 8K is the
1030,
base, but then if you choose another house or something, then they tack on another 1,200 or whatever on top of whatever you choose. So it's like it's not that cheap.
yeah. So you have enough tax savings to do it, but less pressure. So there's that one. And then there's also the opportunity zone. So you could also do the opportunity zone. This is a very interesting strategy that I learned. It is you sell the property and towards the end of the year, then you're purposely delaying the taxes. So let's just say you sell this thing in December. You're supposed to put it into your opportunity zone fund. That fund's supposed to buy opportunity zone property, but you don't. So then it expires and then you pay the capital gain. Your capital gains get triggered in the next year. So instead of paying your taxes in 25, now this is due in 2026, but you don't file that tax return until 2027. So it's like the ultimate like deferral, kick the can strategy. You just got to be ready to pay the piper in that time. But it does give you, a full year extra to go come up with creative ideas to do this. Cool. Well, let's see. We got a couple more questions here. Oh, you got that covered? But would still apply once we say 10 years. Cool. So that's you. Okay. Nice. And he got it down. Student of the craft. I'm proud. Young Grasshopper has been learning. And he's been a student of the craft for, oh God, 4 years now?
5, dude. I brought you to Sarah, buddy.
5. Oh my God, 5 years. Time flies. Jesus.
This
Yeah.
shows I pay attention to you.
Half a decade. Yeah.
Oh my God, our friends and clients for half a decade.
Yeah. That's epic. Yeah. But Lazy 1031, good tool. Add it in there. It's not
And
talking.
then what about
Can't-
back to opportunity zones? Because I remember you had mentioned that was going to end in 2026, which is literally next year. So what's the point of me doing that now?
I think it's getting renewed in the new bill.
Oh.
Yeah. What's not getting renewed is renewable energy. I was shocked and not very happy. I guess I'm a tree hugger at the end of the day. Minnesota boy moves to California, turns tree hugger, I guess.
Well, yeah, they
But
took out all the energy credit stuff for like the EVs and things
the
too.
EVs, the renewable energy tax credits, that everything that Biden tried to do from the Inflation Reduction Act, it's getting axed. So it's interesting. Yeah. So if you want to still put on some solar onto your investment units today, it probably is a good time to start, just because the two good benefits is that you'll get the 30% tax credit. And then, man, this is actually like almost a capstone course. It was another SARE member. I spoke to him 2 days ago. He did the house hack, STR loophole in the backyard of his ADU. And then he bought some units in Iowa duplex. And then I was just giving him like a strategy for the year. I'm like, all right, man, you used the STR loophole last year. This year, you should probably consider putting solar on your property. So then we broke down the numbers. So on a 50K system, you would get 30% tax credit. So you get $15,000 of tax credit. Then you're able to do bonus depreciation on the remaining 35,000. So then that's roughly about 10K tax savings. So then his true net system is 25 grand. So then 25 grand, and we kind of just assumed like about 7K in electricity bills each year. So then he probably break even after about what, 4 years. So you get free solar after 4 years, which is pretty amazing. Because normal residential solar, if you put on your house and don't bonus depreciate it, I think it takes about 13 years. So because it's investment property, it breaks even a lot faster, and he'll save more money. And I just told him like, bro, just finance it over 15 years. So it's like, dude, put like $1,000 down, just finance the rest, get the tax benefit this year. And then you'll like, of course, save the environment, and then save yourself electricity. But just food for thought from a tax strategy standpoint. I was like, you can do this. It's going to cost a lot of money, but it's going to benefit you in the long run. I'm like, bro, you're not going to move, right? You got a house in SoCal. Like everyone buys a primary kind of just once, right? In California, you don't buy that many primaries in California. But it was just a strategy that we recently talked about.
Then going back to the 100% depreciation thing, like right now it's not 100% guaranteed, right? Because you still have they passed the Senate, but they still have to pass the House.
So the House sent their version to Senate. Senate then made their version, sent it back to House. And then now after it passes the House, then it's going to go to President.
Oh, so it's very likely to pass. Okay, so I'm gonna just assume that it's gonna pass back to 100, but pretend I was a dumbass and I did my cost seg this year, which was gonna be at 40%, and then literally like okay, now they said it's gonna be back to 100. Can I still take the 100, or like can I wiggle and do something to get that, or no? No go.
If your property was placed in service after January 19th, 2025, then it
Yes.
qualifies. But if you did the cost seg and you bought your property in 24, it's stuck in 24's laws. Same thing for 23, because 24 was 60%, 23 was 80%. So only 22, it would have been 100%. So 23, 24, you're kind of SOL. 25, once it passes and you didn't buy between January 1st and 19th, then you're still SOL. But after the 19th, you're in the green.
So pretend that I bought and closed and everything that's like on February 1st, but I already did my cost seg. I already have my report.
Oh, just tell them to remake it for you.
Oh.
Yeah, yeah, they just go change it. Be like, yo, bro, did you see the news? Been hiding on the rock. Duh. I need my
So it's
cost
just
seg
really
redone.
changing being on your side as the CPA, like making the changes. And the reporting thing.
We need the report from the cost seg company because they need to adjust their numbers. I mean, it's easy. It's like
Ew.
instead of 60, bro, just put, or sorry, 40, put it back to 100. Yeah.
Ah,
So it's just mental math, but we're just too lazy. I'm like, I need the report on a silver platter for us.
right, man. I should reach back out to Boomer in like 2 weeks after this goes back to 100%, right?
Oh, yeah, yeah. Wait, which one did you do it on?
I did them on all of them before.
Oh, those. Oh, you're good. You locked it in on the 100% years.
I luckily I locked it, but then now you reminded me like I don't get anything for the depreciate the recapture part. Now I'm fucked on that one though.
1031 exchanges, my friend.
Dude, I have like a 3.25%. Why am I gonna go pay 7? It doesn't make sense. I just rather have the
Oh, yeah,
cash.
yeah. Uh-huh. Yeah. There's taxes and there's economics, right? Yeah.
Yeah, everything still costs like double whatever I paid for, and the interest rates are higher. So it's like, I'd rather just pay the taxes. Not really worth it.
Uh-huh. Yeah. We'll definitely chat once they sell. When do they sell?
Ah,
Ugh, you know,
it's
we need to get those off your plate. Yeah.
Houston is stupid. They work in crazy ways. I don't recommend Houston. Unless it's like you're getting a really good neighborhood. Don't go for
No
crappy.
shade on H-Town. I'll tell Lone. Yeah.
Yeah. I mean, her area is kind of cool. I hung out at her house, but like, don't go to Class C areas. Like, just avoid that anywhere in any city. Just avoid it.
Oh yeah. Yeah. I've been chilling myself. Yeah. Just waiting. Yeah.
Yeah.
Great. Cool. Any other questions from anyone? I appreciate everyone joining tonight. Hopefully you learned a thing or two, or I bored you to death and you could go to bed now. But I appreciate it. If anyone's got questions too, just hit me up on Instagram, the CPA dude. Easiest way to get a message back to me these days. Email's bad, but yeah, still socials, I'll get there eventually.
Yes, this shows that this dude is obsessed with his phone.
Dude, I'm curious. Oh, my sisters and I started tracking screen time. I turned it off because it was really bad at one point.
Yeah.
I think it's bad again. Let me see if I can find it. How bad is it? Oh, it's not
Can
that
you just
bad.
get one of like your employees to manage your social media?
They should though. I mean, all right, I'm at 5 hours, 55 minutes average. So at
That's
one point it was like 9. It was bad.
that's like more than your work day did.
The work is on the phone, dude.
So that means I'm never gonna get my K1s or my tax returns if you're always on your phone.
Not unless you secretly text me. Then I'm like, oh shit, there
Basically,
it
telling
is.
you to finish it faster.
Yeah. Nelson's
Well,
got automations now. Yeah.
well, okay, that's the good part is that so we did get that covered, but I want to let you guys know for because yours is just sticking around. I am recording this. We went through a lot of information. Even I need to, really go back on all of this again. So we've already recorded. I'm gonna clean it up and then send you guys the link later tonight or tomorrow so that you guys can have a copy of it. And if there's things we missed out or there's additional questions, just hit up Tony. Um, for those who are not familiar, like Tony actually also has it's a small community that where people can ask questions like during their office hours. It is another service that you guys can always, if you have a lot things to ask, you guys can consider that option just to help you guys, with planning your strategies. Aside from that, so just gonna give you guys a couple upcoming events that are going on, especially Jonathan, you're in the South Bay side. We're gonna have a picnic for July 4th over in San Mateo with Zen Coast University friends.
Awesome.
That's on on July 4th, so that's in 2 days. And then aside from that, we will have our unofficial LobbyCon 2025 in San Diego. Pretty much that means 100 of us. We're just gonna show up in San Diego for no freaking reason and just go party and hang out under the name of real estate so that you guys can have the whole weekend a tax write-off.
I'm down.
And then the next webinar that's going to be coming up for from Tony will be on September 3rd. Will be for those who are like small business owners who want to do some hacks and maximize your tax savings. So there's a lot of us who are also real estate professionals or just investors. But WT is like you guys have your little side hustles. It's been a great tax write-off. For example, I just got my new write-off phone and I'm very, very happy because I haven't had a new phone in like since wow, 2018. So I'm really happy about that. But that's all thanks to Tony telling me to go do it.
That's
So
been, yeah.
yeah, so I really appreciate our number one voluntold where he has to volunteer at least an hour a month, if not more, just to, answer questions for us. I really appreciate your time, Tony, and your dedication to our homies.
That's always fun. Always chatting with everyone here. Nice to meet you, Jonathan. Nice to see you, Rebecca, again.
Yeah, and then Tony, on your side, anything that's going to be upcoming and new in terms of events that you're doing or places you'll be speaking at, so we can all stalk you
Um,
and follow you and walk with.
oh, there's 719. I think it's free. The is it the Korea Expo or the Aria Expo on the 19th in San Francisco?
This is the boy. You're speaking Chinese about taxes. You don't know Chinese, dude.
Let me
Your
see.
Chinese is like Ha Gao Xiu Mai, and that's probably it, right?
Siwa. Yeah, I can't remember. It's on the 19th. I know I gotta show up. I know we're speaking at that and hosting a booth. It's one of those like voluntold events again where I'm like, all right, sure,
Did
take me.
Wei Ming Ballin told you for that because he's also in that group?
It was Christy Chan, yeah, but
Oh.
Steve, I think. But yeah, 719, I think we're doing that. And then
What city?
San Francisco, I think.
All right.
Yeah,
Any
it's somewhere around then. Actually, I'm curious, where is this thing at? I don't know. I just show up when people tell me to. Like last weekend, I think I was in Burlingame for some other panel event.
Probably for ZCU,
No,
Zenkos.
that was for that one's for Aria. Yeah. All right. I think this one on the 19th is Kriya, but actually, let me go see what it is. I'm curious now. I
So
know
this
we're
is a
we're
strategy,
planning.
folks. The reason why I'm asking is because when he gets to those places, if you go and hang out with him, he'll give you like all of these tax strategies for free, and it makes him look cool in front of others too.
Oh, I
Go do
found
it.
it. All right, here it is, because I don't even know about it.
I love how he's like, I don't even know about it. Let's see. That is in
Saturday the
Flagstaff County
19th.
Fair. I
Oh,
think that's the one in near Irving Street, right? Like 9th and Irving and go down a bit.
free entry and parking.
Yeah,
Yeah.
that's where my guess is. I think. Oh, see, I am right. 9th and Lincoln Way.
11 to 3. Yeah, we'll have a booth there. We're actually planning. We're gonna like I just bought the jockey game. I was watching like binge watching Squid Game. I think we're just gonna play that
Oh,
game and hand
don't
out.
tell me the rest of it. I just finished episode 2. I have 4 more episodes to go.
Oh, you gotta watch before TikTok spoils it. Yeah, so we're gonna have that game, and then I think we're buying like a whole bunch of like shumai and like pineapple buns to give away. Yeah.
Wait, seriously?
Yeah. We're just like at the booth. I don't know. All booths are boring, so why not be cool? I don't know. It's
Yeah.
like free food and play a game.
Yeah.
Yeah.
Oh, do you bring more of your sunglasses and your
Oh,
pens?
yeah. Oh yeah, sunglasses. Oh man, almost out of pens. Yeah, sunglasses I
Oh,
still
I
got.
love your pens. Get
Oh,
more. I need
man.
like a box of these. These are my favorite pens now.
Oh, I think I do need to order some. I think I ran
Yeah,
out.
they're so great. And the sunglasses you gave, yeah, they were awesome. I had a whole bunch in my car, and everyone grabbed them while on our trip.
Oh,
I will happily represent you at every single event with your sunglasses.
oh, thank you. San Diego event. When's LobbyCon?
The San Diego event, so it's the last weekend. It's July 31st to the 3rd. So it's like technically our official days we're advertising is the 31st to the Thursday to the Sunday, but really the big events is on Friday and Saturday. We're all just getting there early just so that we can have excuse to like hang out a little bit more and chat.
Yeah, that'd be awesome.
And everyone just go on to I got a giant Airbnb for people to just like party at our place.
Any stop in LA?
I will
Stuff like
slowly drive down past LA.
that?
Probably because like every year we have it in Orange County.
Yeah,
But this year, like because of the wire fi the fires that went on, the
wildfires.
pricing was too expensive. Like the rooms were
Yeah,
gonna be like over $1,000 something for that weekend.
yeah.
So we're like, F it, we're just gonna go down San Diego a bit more where things were like a lot more cheaper for the hotels and hotel rooms.
Hmm.
But like there's no formal agenda. It's pretty much we just are all showing up at the lobby and getting drunk as hell. We'll have friends sneaking in all the alcohol. We did not tell the hotel. So if we get in trouble and they go like, why are there like 100 drunk Asian people in the lobbies? We're lying and say, hey, it's the Feather Remembrance Day. It's
The
how
Boba
our
Festival.
parents beat the shit out of us with the feather dusters.
Yeah. Uh, um, is 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 Sarah going to make like flyers on social media for all those events?
Well, right now it's under a calendar event right now, and you just fill out the form
Okay.
with your email and like if and you can bring only max one guest
Yeah.
because we are covering the cost for the dinners and
Okay.
so it's like we have a
Sure. Cool.
head
Cool.
count that we can have. I think my
Right.
max might be only 200 people, and beyond that we're fucked. But um,
Yeah.
I'll hit up more of my sponsors for
Yeah.
money to pay for the bill if that's the case. But yeah, all of our friends are welcome to come. So if you have
Mhm.
additional friends who want to join, just pass them the link until I hit 200. You guys are welcome to come and join.
Mhm.
Yeah. And on our house, however many people we can fit into our house.
Yeah.
I think it's a 7-room place, so I think we got plenty of room. Come and hang and party. Yeah.
Cool.
So yeah, all right. So without further ado, thank you again, Tony. I will be recording and I've recorded and send this out to you guys. So take
Tony.
care and we'll see you guys on September 3rd. Good night, everyone.
Thank you, Annie. Thank you,
Bye
Tony.
bye. Have a
Bye.
happy holidays. Enjoy your weekend. Bye.